In today's video, we will be exploring fair value gaps, how you can spot them, how to use them in your trading, and improve your trading overall. Moreover, we will also dive deeper into SIBI, BISI, and inversion fair value gaps. Stick around till the end to ensure everything's crystal clear. Get your notebooks ready, and let's get started. Fair value gap, also known as FVG, is a three-candlestick pattern that is formed when the price moves aggressively, leaving behind an area that wasn't delivered efficiently. In simple words, when there is an area between the first and third candle, which isn't overlapping by the first and third candle's wick or body, fair value gaps act as a vacuum for price, and the price most likely returns to the fair value gap. Now, if we focus on these three candlesticks, there is an area that isn't overlapped by the first and third candle's body or wick. This open area is what we call a fair value gap. Similarly, over here, you can see that the first candle and third candle's wick or body isn't covering this area over here, creating a void in price or a fair value gap. Let's look at some chart examples and see if you can spot those fair value gaps. Here we are on the Euro USD chart. Can you spot some recent fair value gaps? If you look over here, you can see we have this first and third candle. We have space that wasn't covered, so this will be our fair value gap. If we move ahead here, we have the first and third candle. And the area over here isn't being overlapped by the first and third candles, so this will be our other fair value gap. Just below that we have another fair value gap because the first and third candle doesn't cover this area and the price is delivered inefficiently. You can take time out and practice and train your eyes to spot these fair value gaps on a chart. Now, what is not a fair value gap? If the wicks or bodies of the first and third candles are overlapping this area, just like this, then that means the price was delivered efficiently, and it's not a fair value gap. Let's move ahead and discuss SIBI and BISI. BISI stands for buy-side imbalance and sell-side inefficiency. It occurs when there is an up-close candle that creates a fair value gap, indicating that the market is imbalanced on the buy side and inefficient on the sell side. In other words, BISI is a bullish fair value gap. Similarly, SIBI stands for sell side imbalance and buy side inefficiency. It occurs when there is a down close candle that creates a fair value gap, indicating that the market is imbalanced on the sell side and inefficient on the buy side. In simple words, SIBI is a bearish fair value gap. Now let's look at some BISI and SIBI examples on the chart. We are again on the Euro USD chart. If we look over here, you can see an aggressive bullish price being delivered, creating an imbalance on the buy side and an inefficiency on the sell side. So this will be our BISI or our bullish fair value gap. Just above that, we have another BISI or a bullish fair value gap that was created due to energetic bullish price movement. Moving ahead, you can see that the price showed a strong bullish price movement, causing an imbalance on the buy side, and the sell side wasn't offered fairly, creating a BISI or bullish fair value gap. Similarly, right above that, we have another BISI. If we take a glance at this side, we notice the strong bearish price movement that created sell side imbalance and buy side inefficiency, leaving this huge open gap behind, so this will be our SIBI or our bearish fair value gap. You can again take time to spot them on your chart and train your eyes to spot them subconsciously. Now, when a fair value gap is created, I am looking at three important things about that fair value gap, which would be its open, close, and CE, which stands for consequent encroachment or 50% of a fair value gap. Most of the time, the price will return to the end of the fair value gap before continuing the order flow. Remember, the price shouldn't close beyond the consequent encroachment or the mean threshold of the fair value gap, or it will invalidate our fair value gap. That brings us to our next concept, which is inversion fair value gap. When the price closes beyond the consequent encroachment, or when the price completely fills a fair value gap, which invalidates our fair value gap, resulting in an inversion fair value gap. And most of the time it acts as our support and resistance. If we have a look over here, you can see price completely filled our fair value gap, so this will now be your inversion fair value gap, and the price is most likely to treat this as support or resistance. If you can fully understand fair value gaps, then it is going to help you in trading ICT, and most of the time, you can place trades solely off fair value gap rejections. Before moving forward, do you want to master ICT basics to advance in weeks? Check out our Trading Titan blueprint by clicking the link in the description below. We only have a limited 60 spots available. Now let me quickly show you how you can use fair value gaps to take trades and make money. Here, I am on the daily time frame for the Nasdaq 100. As we can see over here, we have this fair value gap, which isn't invalidated by the price yet. If we look at the left, we are near this fair value gap, which got completely filled and disrespected, so we are most likely to expand higher after retracing into this fair value gap. I will drop down to a 1 hour time frame and wait for the market structure shift, which we got over here. Now let's go even lower, dropping to 15-minute time frame. We have this fair value gap on a 15-minute time frame which we can use to take our entry from. We would place our stop loss below this candle, and for target, I would like to target a 1 to 2 risk to reward ratio, or if you want you can target the buy side liquidities above. But I will place this trade and see how it plays out. We got tagged into our trade almost immediately. I will let it run. You can see the price almost shot up to our take profit. We had a little bit of retracement and consolidation, but we eventually hit our take profit. See how we can take trades and make profits solely using fair value gaps. Let me show you another example of using fair value gaps to take trades. Here we are on Euro GBP. On the daily time frame, we can notice that we have this fair value gap that was utterly disrespected, which means it will act as resistance now, and we can make possible short trades off this area. Dropping down to 1 hour time frame, we see this fair value gap over here as well, which I am interested in. Let's drop down even further to a 15-minute time frame. I am still interested in this fair value gap over here. I would place my limit order on this end of this fair value gap and stop loss would be right above this recent swing high, and for take profit, we would target the closest sell side liquidity. We got our entry into the trade right away. After that, the price consolidated and ranged for a bit before melting to our take profit and going even further below our take profit, which could have given us a 1 to 2.8 risk to reward ratio. As a bonus for watching this far, here is a golden tip for you. You can also use this indicator for fair value gaps, which will automatically mark fair value gaps, saving you some time. But I would not suggest you rely on indicators for your trading. Rather than, use it as a help to practice spotting fair value gaps. If this video gets 50 likes, I will upload the video on daily bias as well. Don't forget to subscribe to our channel for more videos like this in the future. Thanks for being part of the community.